Have you ever wondered what it would look like if the financial system tried to warn us before it broke? Because right now, it is warning us. And it isn't whispering, it's screaming. There is a signal, quiet, simple, almost invisible to most people, that has appeared before nearly every major economic disaster of the past century. It flashed before the Great Depression. It appeared before the dot-com collapse. It warned us before the 2008 global financial crisis. And today, it's glowing brighter than ever. It's called the yield curve inversion. Most people don't see it. Others ignore it. But those who understand it know one thing. This signal does not show up by accident. It is the closest thing the economy has to a seismic tremor before an earthquake. And here's the unsettling part. This time, the inversion isn't normal. It's deeper, it's longer, and it's more extreme than anything we've witnessed in modern history. On the surface, everything looks calm. Stocks are climbing, confidence is high, the headlines look reassuring, but deep underneath, the foundation is shifting quietly, relentlessly, just like it did before every crisis we swore we would never repeat. To truly understand what's happening, we need to trace this signal back to where the pattern first began. So now, hit that subscribe button, and let's begin. To understand why this signal is so powerful, we need to slow down for a moment and look at what the yield curve actually is, not as a chart on a screen, but as a reflection of the economy's heartbeat. In the simplest terms, the yield curve maps the cost of borrowing money over time. Short-term interest rates represent the immediate future, the next few months, the next few quarters. Long-term rates represent the distant horizon, 5 years, 10 years, even longer. Under normal circumstances, long-term rates are higher. That makes sense. Lending money far into the future is riskier. Anything can happen: wars, inflation, recessions, political turmoil. Investors demand a premium to take that uncertainty. But when the yield curve inverts, everything turns upside down. Short-term rates suddenly rise above long-term rates. It's like charging someone more interest for a 1-month loan than a 10-year one. And historically, it only happens when investors are deeply concerned about the immediate future. So concerned, in fact, that they would rather lock up their money for a decade than leave it exposed for a few months. An inversion is not just a line crossing another line. It's a message, a sign that liquidity is tightening, that credit is weakening, and that something in the economic engine is grinding under pressure. And here's what makes this signal unmatched. For over a century, it has predicted every major recession. Not almost every single one. It doesn't tell us the exact day the storm begins, but it tells us that the clouds are forming and that the air is about to change. And if we follow the trail of this warning back through history, we can see the same pattern repeating again and again. So let's go back to one of the most iconic periods in financial history, when this signal lit up and the world ignored it. Let's start with 1928. America was roaring. Technology was booming. Confidence was overflowing. The stock market climbed like it had forgotten how to fall. Every headline promised a new era, one where good times weren't just expected, they were guaranteed. Then the yield curve inverted, quietly, without drama, without panic. And what happened next? The market kept rising for nearly 2 years. Investors thought the signal was irrelevant, just noise in a world that seemed unstoppable. But beneath that calm surface, credit was tightening and liquidity was draining. When the breaking point finally arrived in 1929, it came fast and violently. The crash wiped out fortunes, banks, and belief in the myth of permanent prosperity. Decades later, the same pattern returned. In 2000, excitement had a new name: the internet. Tech stocks soared to impossible heights. Companies with no profits and barely any products reached billion-dollar valuations simply because investors believed the digital future couldn't fail. Then the yield curve inverted. People insisted the rules had changed. But when the dot-com bubble burst, trillions in market value evaporated almost overnight. And still, the world didn't learn. By 2006, real estate was the new obsession. Mortgages handed out like candy. Banks built castles on leverage. And everyone believed housing prices could only rise. Then the yield curve inverted again. The reaction was familiar. Optimism on the surface, stress underneath. Stocks climbed for another year and a half. Everything looked strong until it wasn't. When the collapse hit in 2008, it became the most devastating financial crisis since the Great Depression. 3 different eras, 3 different bubbles, the same signal, the same illusion of safety, the same painful ending. History doesn't repeat perfectly, but its rhythm rarely changes, and each time, the yield curve flashed its warning long before the world was ready to listen. If past inversions were warnings, the one we're living through right now is a siren. The current yield curve inversion began quietly in August 2022. At first, it looked like a temporary distortion, something that might correct itself as inflation cooled or as the Federal Reserve shifted policy. But instead of fading, the inversion deepened, then it stayed. And then it refused to end. Month after month, the curve pushed further below zero, sinking into territory not seen in decades. By the middle of 2023, it became clear this wasn't just another inversion. It was becoming one of the longest and deepest in modern financial history. How deep? Deep enough to rival 1,929. Deep enough to mirror 2006 to 2007, and in some ways, even more extreme than both. But here's where the story gets unsettling. In 1928, the world ignored the signal because the market kept rising. In 2006, people dismissed it because unemployment was low and growth looked solid. And today, the pattern is nearly identical. Stocks continue to rally. Major indices hit new highs. Unemployment remains close to historic lows. Corporate earnings appear strong. Consumer spending, at least on the surface, seems resilient. To the average person, the economy looks healthy, maybe even unstoppable. But that's exactly what makes this moment so deceptive. The calm on the surface doesn't reflect the pressure building underneath. Financial conditions are tight. Borrowing costs have doubled. Banks are quietly reducing lending. Families are burning through savings. Credit card balances are hitting records. Delinquencies are rising in the background, even as headlines celebrate strong job numbers. The disconnect between appearance and reality is widening, just like it did before every major crash. And the longer this illusion holds, the more dangerous it becomes. Because a delayed impact doesn't mean a softened impact, it often means the opposite. The market keeps climbing, confidence keeps building, and risk keeps accumulating until the weight of it all becomes too much. That's why this inversion is so alarming. Not just because it's deep, not just because it's long, but because it's happening during a moment that feels on the surface remarkably stable. History shows us that these are the moments when the system is most fragile. And beneath today's optimism lies something even more concerning, the one factor that makes this cycle fundamentally different from every crisis before it. If the yield curve has been inverted since 2022, if borrowing costs are the highest in decades, and if history tells us that deep inversions always lead to recessions, then why hasn't the system cracked yet? The answer is hidden in the aftermath of the pandemic, an unusual economic cushion unlike anything in modern history. When governments unleashed massive stimulus programs during COVID, households ended up with more than $2.5 trillion in excess savings. It was a financial shock absorber, a soft layer of protection sitting between consumers and the rising cost of everything. And for a while, it worked brilliantly. Those savings didn't just help people survive, they helped them spend. Consumers bought cars, booked vacations, dined out, and fueled corporate earnings through 2021, 2022, and even into 2023. Businesses kept hiring because the demand never seemed to slow. The economy looked surprisingly strong, almost invincible. Many analysts pointed to this resilience as proof that this time is different, that the inversion had lost its predictive power. But that resilience came with an expiration date. By late 2023 and into 2024, the wave of excess savings began to fade. One estimate showed that most of the pandemic cushion had already been spent, especially among lower and middle-income households. And when the savings dried up, something started shifting beneath the surface. Credit card balances surged to record highs. Buy now, pay later usage skyrocketed. Auto loan delinquencies crept upward. And for the first time in years, consumer delinquencies on credit cards began rising sharply. Households weren't spending because they felt confident. They were spending because they had no choice. Essential costs, food, rent, transportation kept rising, and consumers started leaning on credit to maintain the same lifestyle they had during the stimulus era. The buffer that held the economy together for 2 years is disappearing. And once it's gone, we're left face to face with an economy exposed to the full force of high interest rates, tightened lending, and a financial system already strained beneath the surface. In other words, the shield that delayed the impact is now cracking, and that's where the real danger begins. Because this cycle isn't just about savings running out. It's about something far larger, something woven into the very structure of the global economy, something we've never faced at this scale before. Every economic crisis has a spark. In 1929, it was runaway speculation. In 2000, it was the fever of the dot-com boom. In 2008, it was the illusion that housing prices could never fall. But today, the danger isn't coming from one sector or one obsession. It's coming from every direction at once. What makes this cycle truly different is simple. The entire global economy is carrying more debt than at any point in human history. Household debt, corporate debt, government debt, short-term, long-term, fixed rate, variable rate. Student loans, auto loans, mortgages, credit cards. Every corner of the system is built on leverage. And leverage is a powerful tool on the way up, until interest rates rise, and suddenly, the cost of maintaining that debt becomes impossible to ignore. For more than a decade, near-zero interest rates made borrowing feel weightless. Households expanded their budgets, corporations refinanced endlessly, governments spent far beyond their revenues, assuming debt would stay cheap forever. Then, almost overnight, everything changed. Interest rates surged from historic lows to multi-decade highs. Families with variable-rate mortgages saw their monthly payments jump by hundreds, sometimes thousands of dollars. Businesses facing refinancing watched their borrowing costs double or triple. Governments found themselves spending more on interest payments than on infrastructure, growth, or innovation. The system isn't just strained, it's pulled to its limit. And what makes it even more precarious is how interconnected the debt has become. In 2008, the problem was housing. Today, a shock in any major debt market can ripple through the entire economy. Rising auto loan defaults squeeze lenders. Credit tightens, auto sales fall, manufacturing weakens. Corporate bond stress forces companies to cut hiring. Unemployment rises, consumer spending slows. Expanding government deficits shake bond markets. Borrowing costs spike, global markets react instantly. Each sector is a single thread. Together, they form a web. And when one thread breaks, the strain shifts to the rest. That's why this time is different. The vulnerability isn't contained, it's universal. And with the yield curve flashing its deepest warning in decades, the pressure inside this debt web is becoming impossible to ignore. Because beneath the calm, the fractures are already spreading. On the surface, the economy still appears strong. The headlines celebrate job growth. The stock market edges toward new highs. Analysts confidently declare that the worst is behind us. But if you look past that polished exterior, just a layer beneath the optimism, the fractures are already spreading. One of the first warning signs is corporate bankruptcies. Over the past year, they've been rising steadily, though quietly. These aren't the headline-grabbing collapses of major banks or global giants, at least not yet, but a wave of mid-sized and smaller companies buckling under the weight of higher borrowing costs. These businesses thrived when money was nearly free. Now, refinancing their debt feels like trying to breathe through a straw. And at the consumer level, the story is even more revealing. Credit card balances have climbed to record highs not because confidence is booming, but because many households have run out of alternatives. Essentials cost more. Paychecks don't stretch as far. With savings largely depleted, credit has become the fallback, and it's fraying. Delinquencies are rising across credit cards, auto loans, and even some categories of mortgages. It's the same trajectory we've seen before every recession. People fall behind gradually, then suddenly. Even the labor market, often used as proof of economic strength, offers a subtler truth. Unemployment remains low, yes, but the quality of jobs is shifting. Full-time positions are quietly declining. Part-time roles are increasing. And the number of Americans juggling multiple jobs is growing at its fastest pace in years. This isn't prosperity. It's pressure. Meanwhile, small businesses, the backbone of U.S. employment, are being squeezed by higher rates, weaker demand, and vanishing margins. Their financing costs have doubled. Their customers are cutting back. Many are surviving on razor-thin cash flow. Individually, each of these cracks might seem manageable, but together, they form a pattern that always emerges before the breaking point, and one the yield curve signaled long before the data revealed it. All of this leads to a difficult truth. What's coming may be more than a downturn. It could be a fundamental shift in how the system holds itself together. So, where does all of this lead? If the yield curve is flashing its deepest warning in modern history, if debt is stretching across every corner of the economy, and if cracks are forming beneath the surface while the headlines still promise stability, what happens next? The truth is, no one can predict the exact moment the system shifts. Crises don't announce themselves on a schedule. They build quietly, silently, until one day the pressure becomes too much and the release happens all at once. That's how it unfolded in 1929, in 2000, in 2008, and the signals today suggest that the next turning point may already be forming in the shadows. But the message of the yield curve isn't panic, it's preparation. Preparation means understanding the risks before they become obvious to everyone else. It means paying attention to the things most people ignore. It means recognizing that calm markets can hide fragile foundations and that awareness is a form of protection. So let me ask you this. Do you think the current calm is real, or is it just the quiet before another reset? Are we witnessing a soft landing, or the first tremors of something larger? I'd love to hear your thoughts, because the best conversations in finance come from people who ask the hard questions before the world is forced to. So drop your perspective in the comments below. What do you believe comes next? And if you want to stay ahead of the story, if you want to understand the deeper signals shaping the economy before they hit the headlines, then make sure you subscribe. This channel is built to help you see what others overlook. Hit that subscribe button, turn on notifications, and I'll see you in the next video.